Welcome to Investors Hangout. This fortnightly interaction to help you learn more about saving and investing is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, today we're going to be talking about how to configure the fixed income part of your portfolio. And with me to do that is Dhirendra Kumar, who is our CEO here at Value Research. Welcome, Dhirendra.
Thank you. Thank you, Rachel.
Now, Dhirendra, the return on a lot of the fixed income avenues generally preferred by investors has come down, and we've been getting a lot of questions, especially from retirees, on how they can enhance the yield or the return on their investments. So, what advice do you have for them?
Yeah, I have some advice, but the remarkable decline in interest rate and this pandemic has only accelerated that trend that RBI has gone about cutting interest rates, the repo rates, and interest rates following that. It's very substantial. Many a times we think that it is a 0.5% decline or 1% decline, but think of it. I'll just give you an example just to illustrate the numeric part of it. If interest rates were 10% for just being a round number, and if they come down to 9%, it looks like a 1% decline. But for a retiree, it is a 10% decline in income. And 10% decline in income might, can completely alter your spending budget. And, if you're, and if that is your primary source of income. So it is a very, damaging thing which has happened to retirees, more so for people who don't have that margin of safety. They don't have little more than enough so that they can get through with this. Getting on to how to deal with it. You have very limited options. In fact, for everybody should be, if I have to create a hierarchy of fixed income alternatives, what you should have, the first step should be anyone looking to derive income from his investment. The first step should be going for that guaranteed income, fixed income alternatives. They're absolutely safe, more so for retirees where their risk tolerance is low and they will not be comfortable with little up and down in the value of their investment. So the senior citizen savings scheme, yielding 7.4%, but there is a problem. Maximum investment that can be made here is only 15 lakh rupees. Pradhan Mantri Vyay Vandana Yojana, offered by Life Insurance Corporation. Now, this is an interesting option, yielding 7.3%, 7.4% once again, but a maximum investment of 10 lakh rupees. Followed by, I would say post office, post office monthly income scheme, which can generate that monthly income for you, yielding less, 6.6%. But I think the key thing is that they're guaranteed. There is an issue which may not be a problem with, there is a constraint here that all these investments are locked in, that they may not have enough liquidity. If you want your capital back at some point, because the senior citizen savings scheme is a 15-year term thing, or the Pradhan Mantri Vandana Yojana is a 10-year term thing. Likewise, post office is six years. Of course, you can take it out with a little bit, small fee for premature withdrawal. And that is okay for retirees because that money has to lie there and you have to derive the income. So this should be your first step. And beyond that, you have to optimize your return. One can look at the fixed income alternatives, fixed income funds, and those fixed income funds you have to really be very selective. All kind of funds may not be suited for you. I would say that just consider short duration fund, or selectively the corporate bond fund and banking and PSU funds.
All right, but what about yield enhancement beyond what these avenues you just listed can provide?
Yield enhancement, meaningful yield enhancement will only come from equity, but it's not an easy thing because equity comes with its own, volatility, which could be quite unnerving. So anybody who has little more than what he needs to derive income from, that money should be invested in equity. How you go about doing it, what percent of allocation, it entirely depends on your scale of investment, your need for income, how much income you need. If you don't have that margin of safety, then there is a problem. But if you have a little bit of capital beyond the capital which will not produce income which you need essentially, that money should be invested in equity. And that should, the same rules to follow. Invest regularly, don't invest at one go, and invest over, even if you have 15 lakh rupees, 50 lakh rupees to be invested in equity that is beyond the fixed income investment that happens to be 20% or 30% of your total money, that money should be spread over a long period of time. That it's, the deployment itself should be done over something like 18 months to 3 years, because the risk of catching a market high and getting used to the volatility, it's important. More so for a retiree, because uh, a big decline soon after you invest will drive you out of these investments forever, and you'll be deprived of the opportunity which equity offers, and that is an essential thing. Most people think that once you are retired, you don't have to, you shouldn't be taking risk. In fact, not taking the equity risk might be more risky, because the reality is that if you can keep consuming all the income generated out of fixed income, then you run the risk. Your capital will not get enhanced, and you will have to eat into capital, and that is a very grim that has a very grim outlook, that you will outlive your savings.
Now, Dhiren, certain NBFCs and state power corporations have been issuing bonds and deposits with a return of more than 9%. Now, these look rather attractive, even if not as attractive as equity. So, what's your opinion on them?
Uh, yeah, some of them are attractive, some of them are also safe. But there is a big problem there, and most individual investors should steer clear of them for that particular reason. One is that there is always a catch. When you have this 9% yielding, or 9.25% yielding, some government-backed entity offering a bond, uh, there is a catch that, if they ever default, there are safety nets, but individuals may not be able to reconcile with it. If there is a problem ever, then it will cause great deal of anxiety from something which you thought was absolutely safe. The other is the diversification. I think diversification is critical. When you invest in a fund which is yielding some closer to that, or maybe little less, maybe 25 basis point less, or half a percent less, but the problem is that, these are big ticket investment that you have to make. If you invest in one of those bonds, the minimum ticket could be 10 lakh rupees or 25 lakh rupees, something like that, and that will be a substantial part of your money. Mutual funds offer you, the high yielding funds will offer you the diversification. Maybe the funds also face that problem. They can face a default with such a bond, but that will be 2% of your money, that will be 5% of your money. It won't be 100% of your money, or it won't be 50% of your money. So I think what bond funds offer you, the diversification across a scale of fixed income investments, bonds of various kinds. Very unlikely that a mutual fund will face a problem with all its bonds and the money gets stuck. Of course, the Franklin problem is actually scaring people away. But I look at it more as a one-off thing, and it happened at an unprecedented time, bad timing, at a very of a very different scale, and of a very large fund. And understandably, it is reason to be, it is scary. It is, it has all the variables which, which makes us more conservative in our approach to investment. So I would say diversification is a big benefit. One should not have a large allocation to any such bond.
Now, despite the drawbacks in these deposits and bonds that you pointed out, there are still going to be investors who are going to want to invest in them. So, do you have any advice on how they should go about it?
Yes, understand it fully well. Understand the caveats, because the problem is that somebody will just be looking at the rating, and they might have lower rating, but simply the caveats make it more safer that there is some kind of fallback for those bonds, that if they ever default, the money can be derived. Understand it fully and try to diversify, even at your level, even if you have to invest. Assuming that you have, say, unless you have sizable money, you may not be able to diversify well. So that is why I think for most investors, it will be useful to keep away from them. But still, unless you have a sizable money and these investments are not more than 5-10% of your total investment, I think one should not invest in them. If the 10 lakh rupee is going to be 5% or 10% of your money, by all means invest, because There'll be absolutely no cost to this. Some of them are safe with little uncertainty, and understand how they are structured. Where are they? How are they deriving their safety, or what guarantees your safety? What is there in the design? Because I can I recall some of these power sector power distribution companies, which are loss-making companies, and they are rated very low by the credit rating agencies simply because their cash flows are not good enough. It is not indicative of these companies being able to honor the promise of repayment of interest and principal on time. Where it is deriving, but why still invest? Why I still feel that they are okay, or they're little safe. They're deriving the safety for the depositors by the fact that government is guaranteeing that the state government getting the money from central government on the reimbursement of GST, it will first go towards paying the depositors money, depositors interest and principal. So that looks like almost like a quasi government guarantee. But despite having this, there could be delays. Sometimes it may not come from the company, and if it has to come from the government through the RBI with a lien on those income, it might cause anxiety for those investors if you don't get your interest on time and you depend on that.
Thanks, Dhiren, for shedding light on these various fixed income alternatives. So we're now going to move on to the questions that our viewers have sent us. And the first one is from Manjunatha Sudur G, who asks, how are short duration and corporate bond funds different? Also, which one between them is the safest in the current scenario? And how do I use the monthly portfolio disclosure to identify risk in these funds?
One is short duration funds can be diversified. They can be investing a part of the money in sovereign bonds. You have these alternatives. These are the fixed income alternatives. You can be investing in government bonds and corporate bonds. And so corporate, short duration fund can invest all over. Corporate bonds can invest only in companies' bonds. And both can act. My sense of the safety or the risk in a debt fund comes in a very limited way, because a fund can have 90% allocation to highly rated papers or government bonds, and they carry the government's guarantee of timely repayment of interest and capital. But 10% capital invested in a very poor quality fund which meets with an accident, that can cause havoc. It can eat away 2 years return or 1.5 years return generated by the fund. And I don't think investors are prepared for that. Fixed income investors don't invest for such blow-ups in a fixed income fund. So all what you see in the monthly fact sheet is the credit rating. I think focus on the lowest credit rating and the allocation in a fund in that credit rate, in that particular security. Maybe go to value research online and look for that company in which that fund has invested, and look for there is a particular variable on each company's page, that what is the likelihood of this company going bankrupt, what is the likelihood of insolvency, how close it is to bankruptcy. And it is a 9-scale matrix which is available on all listed companies in the country. So that will be useful. I have found that all the blow-ups in the past are stock pages on those companies were indicating that, whether it was Jet Airways. Of course, I don't think there is any secret in that. The cash flows are stifled to an extent that they are very likely to be a defaulter. So look for the lowest credit rating issuance or those bonds in a fixed income fund. And if it is a corporate bond fund, look for that company. If it is a listed company, you can get a pointer on value research online on that company.
Now Kamal asks, would you suggest staying invested in dynamic bond funds?
Dynamic bond funds, they have most fixed income funds. They have a narrower goal in terms of short term, medium term, long term. Dynamic bond funds can actually be short term when it's opportune, or long term when it is opportune, or they can move into a certain part of the credit matrix. So they have absolute freedom to invest wherever they want to. And unfortunately, we don't have too many dynamic bond funds which have been able to build a great case for themselves over a full interest rate cycle. So I would say that they have the flexibility. Ideally, I would have preferred to have a dynamic bond fund which can fulfill most investors' need. But in the absence of that, we are limiting our framework to something which is narrowing the universe to short duration funds, corporate bond funds, and banking and PSU bond fund, PSU funds, simply because we have not come across a great dynamic bond funds.
We've now got a question on hybrid funds from Ayush Maniyar, who asks, how do I pick a reliable hybrid fund for the long term as I find it quite difficult given there are so many funds?
Start with our rating, and it's a good starting point. It is not a conclusive thing. I don't think you should just look at rating and invest in that. So your starting point should be narrowing the universe, 5-star, 4-star fund. Beyond that, look for funds which have been able to deliver superior returns over a full market cycle, and that, to my understanding, will be about 4.5 years right now. We have seen a down phase within this. We have seen an up cycle as well. And second thing to look for is the fund manager still there. And uh, another thing which value research analysts look at when they are looking at a hybrid fund is that what is the range of asset allocation? Because when I'm looking at hybrid funds, there is a in the classification system there are 3-4 kind of hybrid funds. I'm primarily referring to the aggressive hybrid fund, which is a steady take, or equity income fund. Sorry, equity savings fund, which are a third of the money is invested in equity, or the aggressive hybrid fund where uh, over 2/3 is invested in equity. In this case, the value research analyst framework is that what is their asset allocation discipline? If the stated asset allocation is that this fund will be 65 to 75% into equity, when do they rebalance? How actively they rebalance? And even if the fund has not been the best performer, but it has been a more disciplined asset allocator, on its asset allocation with it, we actually go with that because that is more predictable. The brilliance of a fund manager can have cyclicality, but the discipline of a fund manager is something which is very bankable, and that itself is a huge reward. Or when I consider a hybrid fund, and if a fund manager is extremely disciplined with his asset allocation, that itself will generate something meaningful for me. So we go by these three parameters: performance over a full market cycle, the asset allocation discipline, and the fund manager still being there.
All right, now here's a question from Arun Vishwanathan who wants your help planning for his goals. And he asks, how do I calculate the corpus which I need to accumulate for retirement? Also, I am investing in around 7 to 8 funds and have split my major goals into 3 headings: retirement, child's education, and expensive buys like a car in 5 to 6 years. Is it fine to invest in these many funds?
Uh, it's desirable to have fewer funds and good funds, because if you have too many funds of varied kind, you end up being an index fund at the in the underlying. And how to go about estimating the money that you need? Broadly, there are two. The one variable which only you are aware of is that the lifestyle that you are targeting. If you are just trying to and a good starting point, and all these are all this is in the realm of great uncertainty, more so given that what the times we are living in, very hard to guess what it will be, but still an estimation of some kind will be helpful. So how far is your retirement, and how much do you need now for your to sustain yourself, or how much income requirement do you have essentially? Extrapolate that with the inflation. And at Value Research Online, you can use tools to estimate how far is your retirement, how far, time and money are the two variables which you can provide to estimate the money that you require. Once you have, and basically for these three goals, you have different time frame. So you can do that estimation, and you will have your cash flow estimation that 5 years from now, how much money you need for your car. 8 to and it's something like when your child gets into the college, how much money you need. Very difficult to estimate this because this is such a variable cost. If your child gets into the finest engineering college, it will not be that expensive. But if your child gets into the finest engineering college abroad, it will be way too expensive. And I really wonder that you can actually provide for. You can do the estimation that whether you need 10 lakh rupees or whether you need 1 crore rupees. Or there could be the other variables in the educational framework, and then it is I don't know what the future is going to be. But last 10 years, the inflation of the education cost has been among the highest, just below the healthcare cost, the way it has gone up. I don't know what the future will be, but I think it will, if it will not be as bad as it has been, uh, even if it remains where it is, it will be something sizable. So you will have to do this estimation. Various tools will help you do that. Should you have many funds for these independent goals? No. If you have identified 3, 4 funds, just think in terms of what part of your money is for that fund, that particular goal. And the important thing to note is that as you get closer to your goal, start withdrawing. Maybe you can have separate accounts. You have chosen one fund and you want to invest for 3 goals. Maybe open 3 accounts in the same fund. Maybe 5,000 going, towards your car, another 12,000 going towards your retirement in the same fund, and another 15,000 going for another goal. That way, you will have a mental segregation without having too many funds.
All right, now Bharat Singh D. Rathod says, I am a small scale retail investor and wanted your opinion on gilt funds in the current scenario. Should I invest in them?
Gilt funds are absolutely safe, but they are not free from decline in value, because when interest rates go up, they go down in value, and when interest rates go down, uh, they go up substantially, and that is why they have come in the limelight. Because of this crisis, because of this pandemic, RBI went unexpectedly. We have seen a serious interest rate cut, and that led to great appreciation in the gilt prices, government securities going up substantially. And the government securities, they have two things going for them, why they benefit substantially when interest rates go down. One is that only government is able to offer us very long duration bonds. If you want to buy a 15-year bond, you may not get a corporate bond, but you will get a government bond where which will expire or mature after 15 years. So in that sense, and then there longer the maturity of the bond, the steeper the steeper the decline and higher the appreciation. So because of this steep cut in interest rates, gilt funds benefited, and that is why in the worst of times, the 1 year return on the gilt fund was nearly 20%, and that is attracting a lot of investors. But I think the interest rates may go down a little bit, and gilt funds can benefit a bit. But interest rates will also go up, and when interest rates go up, gilt funds go down in value. And whenever interest rate, and of course, let's hope that interest rates will go up steadily, not very dramatically or sharply. But still, any interest rate hike will translate into gilt funds declining in value. Be ready for that. What you have seen in the past came as a surprise. And the decline will come in a fairly predictable way. I don't visualize that in the coming times. And so I think the best time to invest in gilt is gone. There may still be little steam left, but it is not too much. So that is how gilts work, and that is how gilt funds will actually show. If you look at, so just be aware of this. There may be some upside, and beyond which there will be downside as well.
Okay, and now we've got Saurabh who's written in with two questions. And the first one is, how frequently should we analyze the performance of schemes we've invested in? And he also asks, what is the correct strategy for setting up a systematic transfer plan?
I think an annual checkup of your investment is good enough. If you have carefully chosen your investment, I think annually looking at your performance and it should be fine. But I think there are a couple of red flags. which one should, you should, and you can set up after you have made your investment, set up your portfolio at value research and set up an alert on two things. One is that if the fund manager changes, you should be alerted and you should be aware of that. And when the rating of a fund slips below 3 star, I think it is a time, because there is something which one should take note of. And one should try and find the reason, and if those reasons are going to be of, very impactful. So these are two things which one should keep, which one should set up an alert on, beyond which you should generally do an annual check. Annual check on two, three things, not necessarily reviewing the fund, because the fund performance should be reviewed typically on a full market cycle. Looking at funds very often or more often is not valuable. I think one should do the annual review primarily to reset the asset allocation. If you decided on 75% equity and 25% fixed income, and if your 75% equity has become 85% equity because of substantial appreciation, maybe time to rebalance. Maybe fixed income has gone down, invest in equity more. Gone down, so take money out from equity or otherwise. So an annual check and having a checklist of all the things to do can be good enough. I think an annual check and those flags, alert on those flags should be good.
All right, so we're going to take one last question. This one's from Manoj Chandak, who asks, what is the difference between ETFs and index funds? Which one is better? And are there any blue chip and multi-cap ETFs available?
All ETFs are mounted on index fund. ETFs, the Nifty ETF or the Sensex ETF or the Junior Nifty ETF that we see, they are index fund. There is a difference in the way we buy them, and that is the primary difference. The way we buy, if I have to buy an index fund, then I just buy it like any other ordinary mutual fund. I put my 10,000 rupee, and depending on the NAV, today's NAV, I'll be allotted as many units. As compared to that, ETFs trade like stocks. They are traded, they are listed and traded, and the NAV of ETF exactly tracks the index. Even the design of ETF is something that there is absolutely, there is minimal tracking error. Tracking error is, the fund's ability to replicate the index with what precision is the tracking, or the difference in that is the tracking error. Higher the tracking error, which means the fund is not able to replicate the index with that precisely. So with that, there are critical difference. One is that when you invest in an index fund, then index funds always have a little bit of cash, or there is some money translate. Some investors are investing, some investors are redeeming, and there could be small cash component in an index fund. So the design of it creates some tracking error. As compared to that, an ETF, by its very design, the creation of those units leads to less tracking error. But there is another problem of so for buying ETF, you need to go to a stockbroker, and you have to place an order. The ETF, the allotment of index fund is always on the NAV. The purchase of ETF is dependent on the supply and demand, and that causes a small premium and discount to its NAV. So ETFs don't necessarily trade at NAV. There could be, sometimes there could be a little high or a little lower than the NAV. And so this is the key difference. You buy ETFs like a stock, though they are all mounted on the index fund. We do not have, too many index options today. And there are many index funds, being launched on different indices, the small cap index and, the mid cap index. But they are getting launched. They don't have a long history. Long time ago, we saw that a BSE, S&P 500 index in India, the BSE 500 index, which was launched by Benchmark, it was having a tough time replicating that index, and nearly 5% of the stock, the fund was unable to buy them, or without any meaningful impact cost. So it is very difficult. Our stock universe is very narrow, and this can sometimes be very difficult. to as these index funds get bigger. So we have seen some very nice, sizable, scalable, and very efficient Nifty and Sensex fund. As we go down the ladder, I think it's a matter of time. It will take some time for our market to mature and gain depth to support large number of varied index fund. And so no, we don't have too many alternatives.
All right, so that was our last question. Thank you, Rain, for answering all these questions.
Thank you.
And to all our viewers, thank you so much for watching and goodbye for now.